Hey traders, this is Blake Morrow, and you are listening to the week ahead video for September 19th, 2021. It's hard for me to believe that we are about 3/4 of the way through 2021 already. Can you guys believe it? Anyway, we've got a lot to talk about today because we're going to talk about the Fed coming up this week, but they're not the only central bank meeting this week. There's a couple other central banks meeting, but there's a lot of events that are happening this next week, and we're going to talk about how we closed the market on Friday. But before I do that, let me mention a few things. Okay, first and foremost, make sure that if you haven't tried out ForexAnalytix, do it. It's only $1 for 10 days. Even if you decide to just go with the light version, that's $20 a month, not the $120 a month, which is our premium version. You can actually still get the mobile app and you can listen to all of our private webinars. But with the premium version, that's what you're going to get to try for the next 10 days. You get to jump in the chat rooms. You can listen to all of our live webinars that we do for all of our traders. You get the mobile app. You're in our community. And you get the advanced analysis, the Elliott wave and harmonic analysis. So make sure you try it out. $1 for 10 days. Also, one thing I need to also mention is I need to mention that if you haven't checked out tradersummit.net, make sure you check out this website. I did a bunch of interviews this last week for Trader Summit, and one of them that was just released at the end of the week was from Jim Welsh of Macro Tides. He talked about like the China situation that's happening right now. And I think it's really important that you go back and listen to his video that just came out over the weekend. Check out all the great content that we have on here on tradersummit.net. It's a great place to just get your start of the day. And you'll find the link in the description of this video. All right, so let's talk about this last week. And actually, let's talk about where we closed in the S&P because this is super important. So we've been monitoring this ascending wedge, finally broke down on Friday. Now, I don't know about you guys, but I've been sucked into quote unquote risk off type of trades before in this very strong uptrend. So you obviously have to be very careful as we go into this time of the year. Typically, this is a time of the year in equities where they're going to trade a little heavier between now and the end of October before you start getting that quote unquote Christmas rally or the end of year rally. But this is the time that the markets usually have a little bit of a pullback anyway. The problem that we've seen in the last year and some change is the market has doubled in value. Now, you could say, well, obviously there's a lot of circumstances why the market has doubled and it's up 100% from the lows. I understand that. The point I'm trying to make here is we've had a really epic rally. And what we're going to find out this week from the Federal Reserve is if the Fed indeed is going to start tapering bond purchases. Let's just think of it like this. And I know you've heard a million analogies, but the party's been going on for the last, well, you could arguably say there's been a long party going on for many years pre-COVID. You could obviously say that. I mean, if you look at the equity markets and what's happened since the financial crisis, right? Since pre-2011 that you can see here in this daily chart, the market's been rallying on stimulus and the very great low rate monetary policy environment, low rates, just very easy money environment. The fact of the matter is this week, the Fed could possibly start tapering bond purchases. It's kind of like, we've been partying for so many years and then all of a sudden the liquidity, the punch bowl, if you will, is slowly being taken away. Is that going to impact asset values and asset prices? Yeah, more than likely it will. And so if you start to see the Fed taper bond purchases this week, or at least even make an announcement that it's going to happen this next month or maybe in November, yeah, you're probably going to start to see stocks actually pull back. Now, when stocks really start to pull back is when rates go up. And the jury's still out when or if that'll ever happen. But regardless, I think if you're long equities, you need to be careful because technically we are starting to actually break down. What's going to happen this week is when the Fed, and it's not, like I said, it's not just the Fed. You have the Bank of England. Okay. You also have, we have the Swiss National Bank that's also meeting, which, I'm not really too worried about. But once you start to see central banks actually talk about reducing the amount of easy money that's out there, their easy money policies, and they're starting to reverse course, that in essence is a risk for equity markets. So what I'm looking at specifically is that we broke this ascending wedge. We actually closed below the 618 retracement of the low that was put in August to the high that was put up in September, the all-time highs. And if you just look at the last rally, and let me get rid of this here. You look at the last rally that really started in September of last year. So think about almost exactly. You can see this is exactly pretty much where we're at, right where my cursor is. But you can see about a year ago, if you take that low, you go to the high, you look at a 38% retracement, it is actually below the 200-day moving average. Realistically, that is the type of retracement that we would all expect coming out of an ascending wedge. Technically, that means from the highs, about a 12% correction. That would put us below the 200-day moving average. Would that disrupt the bullish trend of the equity markets? The answer to that question is no. It wouldn't. And in all actuality, it would say, oh, we're probably, and let me just show you here, we're probably just developing some sort of channel in the market. I mean, even to get to the 200-day moving average is an ascending channel. So if you think about where we're currently at and where we can go, and let me just, I know I'm spending a lot of time on the S&P, but it's important because of the week that we're in. We have another 6% or so, roughly, to the 200-day moving average from where we're currently at. So this week, depending on the Fed and how hawkish they are, that is, going to determine if we go down to the channel support here. Now, I just said if the Fed is hawkish. How often have we thought that the Fed might be hawkish and the market just turned around, posted a false breakdown, and reversed back to new highs? This week, you have to be very, very careful. But the good news is the Fed actually meets on Wednesday of this week. So that means we have Wednesday, Thursday, and Friday to really have a good direction in the market. Meaning, if the Fed is just dovish like they always are, we're going to do a false breakdown, guys, and risk assets are going to probably rally to all-time highs. Like, we'll probably start here, and we're going to end up here by the end of the week if the Fed is just dovish. If the Fed's hawkish, we're going to probably end the week closer to the 200-day moving average. Probably closer to 300, 4,250. That's the good news. The bad news is we have Monday and Tuesday to deal with, right? So I think, look, if I was long stocks right now, based on technically how we closed, I would be a little worried, and there might be some profit taking going into the beginning of the week. We might end up on Wednesday closer to, like, let's just call it 4,400, 4,380 in the S&P. Okay, so I know I spent a lot of time on the S&P, but the fact of the matter is the S&P and what happens in equities is going to drive currencies. So let me give you two situations in currencies. Let's say the stock market rallies. Everybody falls, sucker to a hawkish FOMC, and we get a dovish FOMC. Fed Chairman Powell says, you know me, I'm a dove. I'm not going to change. I'm going to be dovish until I'm out of here, and I'm going to pass this off to somebody else. That could happen. Well, you know what would happen in that situation is you'd have this Aussie dollar that's setting up with a really important low near the 71 cent level that's probably going to end the week near 74, 75 cents, probably closer to 75 cents. You got a bull flag pattern setting up. We hold this 72.50 level, 72.45 level. We get a dovish FOMC. The Aussie's probably going to head towards that 200-day moving average once again. Let's turn the tables around. Let's say that the Fed actually, and the Fed says, you know what, this is the time. We actually do need to start tapering bond purchases, and we're going to tape them at a fairly healthy rate. And the market says, wow, they're pretty pretty hawkish, and it looks like they're going to change monetary policy. You know what's going to weaken and what's going to strengthen? The dollar is going to strengthen, and we are going to see emerging market currencies really come under pressure. This one thing that I've got to show you here with the US dollar Mexican peso, and I know I've shown it to you before, especially if you listen to our daily webinars. This is the S&P, and this is the dollar Mexican peso. And you can see the dollar Mexican peso is really based as the S&P has been moving higher. Typically, you get a strong inverse relationship between emerging market currencies and risk assets. So to just make it really simple for you, stocks have been moving up all of 2021, and the S&P the dollar Mexican peso has failed to break down. So what that means is if stocks actually do move lower, the dollar Mexican peso should rally. Okay, so that is on a hawkish FOMC. You know what else would happen? The US dollar South African rand that has this inverted head and shoulder pattern that you guys have seen here. I know if you follow me on Twitter, which I'm Pipzar on Twitter, you've seen that big reversal above the 200-day moving average. I've been long the dollar South African rand all week. This last week, I know a lot of you guys were too. Congratulations, by the way. It was a big 2% gain in currencies, which is not easily seen nowadays. But that could change, especially with a hawkish FOMC. You could see the U.S. dollar South African rand, reach back above 15 as the S&P sells off. You know what else could happen? Is you could see a really big move in gold. I know, it's interesting. I've done a lot of interviews, again, just going to the Trader Summit website. There's so many great contributors here. If you guys want to see like the list of contributors, and I just filmed with Shy Girl, just over the course of the last couple of days. Her interview is going to come out over the weekend. You guys might see it if you're following Trader Summit, on Twitter. But I'm not going to say this is about Tracy, but I'm going to say this about a lot of people that I've been interviewing over the course of the last couple of weeks on Trader Summit. Everybody is very bullish precious metals. And I know I've been looking at them very skeptically. I almost said skeptically, because they have been trading heavy. And the fact of the matter is, if the Fed is hawkish and we start to see monetary policy become reduced, there is a risk that these precious metals could really come under pressure because they have really been not performing well in a quote unquote inflationary environment. So I'm going to throw this out here for you guys. If the Fed it comes out being kind of hawkish this week, and we walk away thinking, oh man, stocks are going to come down, the dollar is going to rally against some of these emerging market currencies. You're going to see, in my opinion, you're going to see precious metals here. This is the gold chart I'm showing you, but these support levels that come in around the 1680, they're at risk of breaking. I would not be surprised to see gold at 1500. And I know a lot of you might say, well, I'm going to be looking at that as a buying opportunity. That's fantastic. But, if we go from 1750 to 1500 or 1550, 200 points in the gold market is a big haircut from current prices. I mean, you're talking, maybe a 10% move lower in precious metals. Look, longer term, I think precious metals are bullish, or are very bullish, and I think that you look at gold on a longer term basis. I mean, we are making higher highs and higher lows. So, do I think gold eventually moves back above 2000? Sure, but that doesn't mean that in the near term we can't see lower levels first before turning higher. So I want you guys just to think about that. Now remember, I'm gonna say this, guys. If you like what you've heard here today, make sure you give us a thumbs up, subscribe to the channel below, make sure you visit tradersummit.net, make sure you try out ForexAnalytix so you can be with myself and other members of the community. We are all like-minded people. We are trading the markets, and why wouldn't you want to be in a chat room in our community with people that are thinking the exact same way you are? And we don't talk politics, we don't talk religions, we just talk about the markets, and we're really strict about that too. If anybody starts bringing up political comments or religious comments, we nip that in the bud really quick. So we hope you guys join our community, and I thank you for spending your time this weekend with myself, and have a great trading week. We'll see you soon.